This is Matthew Kratter's Bitcoin University. Today I want to talk about how governments rob you blind. We're going to be talking about print, pump, tax, repeat, realized capital gains taxes, and unrealized capital gains taxes. But first, some necessary background. Taxation is theft. Taxation is theft. You've heard the saying before, but do you actually feel it in your bones? Because there's no social contract. I never signed anything. The roads are full of potholes, and I'm forced by the monopoly on violence to pay into social insurance and entitlement programs that I'll never see a dime from and that don't even help the people who really need it. All the politicians work for big war, big pharma, big food, big banking. They don't work for me. Oh yeah, and the ruling class traffics your daughters, eats their babies, and sends your sons to die in the Middle East. So I think that's the necessary context, especially as an American, for understanding taxes in general. Next, how do capital gains taxes work? Basically, you have an entry price and an exit price, also known as the cost basis and the net sale price. You buy one share of stock for $100, including commissions. You sell it for $110, including fees and commissions. So you have a capital gain of $10. And then in the US, depending on your income, your tax bracket, you'll owe something like 15, 20, 23.8% on that. So let's say $1.50 to $2 in capital gains taxes on that capital gain, which is $10. Now, what's unfair about this? Number one thing that's unfair about this, capital gains taxes are theft, as we said. Number two, you end up taking all the risk while the government gets to skim off much of the reward, 15 to 23, 24% of the reward. If your investment is profitable, then the government steals some. But if your investment loses money, you get left holding the bag. And then the government offers minimal ways to offset the loss. For example, in the US, only $3,000 per year of capital losses can be used to offset ordinary income. And to get a chance to offset capital gains in full, you'll need to expose more capital to risk in the markets and hope to achieve a gain this time. So the game is really rigged against you and in favor of the government. But it gets even worse than that. So now it's time to talk about something called inflation, or the inverse of it, which is called monetary debasement, where your money buys less and less goods and services over time. So there's this natural upwards pressure on financial asset prices that's caused by monetary debasement, by debasing the purchasing power of US dollars and other fiat money by printing more of them. So the US money supply, it's increased by approximately 8% per year annually on average over the past century. And that monetary debasement ends up getting reflected in housing prices, in stock index prices going up both of them have gone up about 8% per year on average over the past century. So that mysterious stock market artifact, if you've ever studied finance, you have this artifact called beta, which is what you get when you expose yourself to a stock market index. This is sort of the natural rate of return of a stock market, at least theoretically. This turns out to be nothing more than the flip side of money printing and monetary debasement. The S&P 500 goes up about 8% per year because that's the rate at which the US dollar goes down. Now, money printing robs people of their savings by diluting their purchasing power. So, for example, if you're sitting on $10,000 worth of CDs or T-bills, you're going to get poorer over time since the interest rate on those financial instruments is well below the true rate of inflation. So if you're earning 3 or 4% on a CD or a T-bill and the true rate of inflation is 8 or 10%, you're losing purchasing power. And so what do you do in an effort to maintain your purchasing power in the face of this money printing? You as a saver are then forced out along the risk spectrum into stocks, real estate, Bitcoin, etc. And then here's where injury is really added to insult. Your fiat money is losing purchasing power at the rate of about 8% per year because of money printing. But when your stock index investment, your S&P, SPY, or QQQ goes up about 8% because of this money printing and dilution, you don't get to keep that full 8%, which would only be fair since you already paid income taxes on the initial money when you earned it. But instead of getting to keep that 8% per year on average, you have to pay capital gains taxes on that 8%, especially after you sell it, which means that you're losing purchasing power every year. You're unable to hedge your purchasing power. Governments steal from you in the form of many different taxes, from income taxes to capital gains taxes, to sales taxes, to death and inheritance taxes. Then governments secretly pick your pocket even more by funding themselves with deficit spending that's financed by central bank money printing. The central banks print up the money and buy the government bonds that make the deficit spending possible. So this is why inflation is often called a hidden tax. The government taxes you, and then there's this stealth tax that comes through money printing and inflation. Now let's add the final piece to this wealth extraction scheme. Let's make people pay taxes on their investments before they even exit them. This is the so-called unrealized capital gains taxes. Unrealized because you haven't sold the stock or real estate yet and taken profits, and yet you still owe money on it. So in our example where you buy at $100, you sell at $110 in year one, you would owe $2. But let's say this is an unrealized capital gains tax where basically you haven't sold the stock, but at the end of the year it's gone from $100 to $110. Even if you haven't sold it, you have to somehow come up with that $2 to pay the government if there's an unrealized capital gains tax, which will basically treat this as if you had sold the stock. So let's say you pay that $2, and again, you might have to sell off some of the stock in practice just to come up with the money to pay the taxes. Then in year two, let's say the stock crashes from $110 per share down to $80. Sorry, in that case, the loss is all yours. You don't get that $2 back. And presumably you'll have to wait till it gets back above 110 before you get taxed again. But this is the really unfair thing about unrealized capital gains taxes. And it usually leads to downward pressure on stock markets because people have to sell off a bit of their holdings just to pay the unrealized capital gains tax. But what I want to really emphasize here is that unrealized capital gains taxes are the ultimate wealth confiscation scheme for governments. That's because they have the power to print money and pump asset prices and then tax people on that pump and asset prices. And if you do this enough times as a government, you will end up having confiscated close to 100% of savings or just debased what people have left to such a point where they can't even use it to buy food and shelter. Now, unfortunately, unrealized capital gains taxes are no longer just a concept. It looks like this is coming to the Netherlands. Dutch lawmakers approve a 36% tax on unrealized crypto stock and bond gains. If you're in a country like this, you really should get out as soon as possible. Then there's also the related category of net worth or wealth taxes, which often indirectly impose an unrealized capital gains tax because you're supposed to add up all your assets, subtract your liabilities, and in many cases, the bulk of these assets that are held by people, by wealthy investors or wealthy entrepreneurs ends up being in stock. And it's almost all unrealized capital gains since most of these people have founder shares. So net worth or wealth taxes are a backdoor way of bringing in unrealized capital gains taxes. Unfortunately for governments, though, this always ends up backfiring since the targeted tax base usually ends up fleeing this jurisdiction. This is what happened in Norway, for example. They expected to raise $146 million in additional revenue, but instead $54 billion worth of wealth left the country, and so their tax revenues fell by over $600 million. You can read more about it in this article talking about the exodus that occurred when Norway instituted a wealth tax that was just 1.1%. And now profligate states like California are trying to do something similar. It's having a similar effect. This proposed 2026 Billionaire Tax Act, which is going to be on the ballot, it looks like this November, has already led to a lot of high-profile billionaires leaving California. This would be a one-time 5% tax on the net worth of individuals with over $1 billion in assets. But what ends up happening is those assets end up fleeing the state and moving to Florida or Texas, and then California's revenues fall. But this is what happens when governments get desperate because they have their spending out of control. Then there's the sort of backdoor unrealized capital gains tax that comes from the U.S. exit tax. If you're covered by this, if you have more than $2 million in assets, or you've been a high earner, if you've earned something like $250,000, having that much in tax liabilities over the past 5 years on average, if you end up being covered under this umbrella of the U.S. exit tax, you will then need to pay an unrealized capital gains tax in order to gain your freedom from the prison, the tax prison that America has become. And I would say that exit taxes like the U.S. exit tax are going to be increasingly capturing people because they don't really adjust these exit tax thresholds for inflation. So we could reach a point in the coming years where even someone who owns 2 Bitcoin, that could end up being at $1 million per coin. Obviously, that could be $2 million in assets. And as you have hyperinflation, the average American net worth may end up being something like $2 million, which would have purchasing power of $50,000 or something like that today. So this really is the ultimate evil tax, where you get taxed as you try to escape the system. Then we have this idea of taxing the rich, which never really works out when you do the numbers. The problem here is the U.S. government so profligate in its spending that not even confiscating, for example, 100% of billionaire assets. California is talking about confiscating 5% of billionaire assets in California, but you could confiscate 100% of billionaire assets in the US, and it would have no meaningful effect on budget deficits or debt. So why not raise the tax rate to 100% and really pursue this to its illogical, absurd level? Because as of late 2025, according to this search, the total net worth of US billionaires is approximately, call it $8 trillion. That's equivalent on order of magnitude to US federal spending, which will obviously be much higher next year because of the war. US federal spending at $7 trillion. Hopefully I said trillion here. So you could basically confiscate 100% of the net worth of American billionaires, and it would only buy you 1 year of government spending, not to mention paying down the national debt, which is currently at $39 trillion, and is actually probably above 100 trillion when you take into account future entitlement spending. So this is where we are today, and this is really why you need Bitcoin. You might want to get your money out of that government-controlled bank account or brokerage account before the real confiscation begins. And Bitcoin is so good for this as an exit because Bitcoin is mobile capital that cannot be debased or diluted by fiat money printing, can't be seized by governments like a bank or brokerage account or real estate can be seized. And Bitcoin is mobile capital that can allow you to flee war-torn areas with your savings intact. This is becoming increasingly important as the U.S. spreads war all over the world. Mobile capital can also allow you and many others to form a Schelling point that's able to stand up to government theft and refuse to fund the pedophiles and the forever wars. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.